Hi, welcome back to our series for first-time buyers. So this is a series created just for you if you are on that journey to home ownership. It's to help get you clued up, feeling confident, and really motivated about getting a home of your own. So we've covered quite a lot in this series so far. So if you haven't already seen the other videos, I recommend checking out the first-time buyer playlist and you can catch up on all of them. And I'd also suggest please hit that subscribe button and sign up for notifications so you don't miss any of the final videos in this series. So today's video is about a topic that is really important, but also kind of dry, and that's mortgages. So today we're going to cover how mortgages work, some of the jargon and terminology that the banks use around mortgages because they can be really complicated to understand, and I think they probably do that deliberately. And we're going to talk about how do you work out what's a good mortgage for you and how you can feel confident figuring out how to get a mortgage, like what's the application process look like, how do you prepare for it, all of that kind of stuff. So this video might be a little bit longer than some of the others, but bear with me. We'll chop it up into bits so you can just do a bit at a time so it's not too overwhelming. Right, let's start with what is a mortgage? Well, unless you happen to have been born incredibly wealthy and you're able to buy a house completely outright, then the rest of us need to get a mortgage because houses cost a heck of a lot of money. So a mortgage is just a type of loan, right? It just has a different name, but it's essentially a loan that a bank or a building society gives you to help you buy a property. And so the way that it works is you have to provide a certain percentage of the value of the property. That's your deposit amount. So that is going to be somewhere between 10% up to whatever percentage you can afford, right? But for most first-time buyers, that's going to be around between 10 and 20% of that property value is the amount that you will pay as your deposit. And then the rest of it, so 90%, 80%, whatever that remaining percentage is the amount of mortgage that the bank will loan you in order to buy the property. So you're essentially taking that whole property value and you're saying, right, I can pay 10% of that up front, and then bank, I need you to lend me the rest of that money and I'll pay that back to you over time. So that deposit percentage that you pay, that percentage amount is quite important because what the bank is always looking at is what percentage of the property are you paying up front for and how much are they basically paying up front for, and you pay them back. And what that percentage is called is the loan to value ratio. I'll say that again, loan to value. And it's shortened into LTV. So you may have seen on like mortgage calculators and stuff, they may talk about like a 90% LTV or an 80% LTV. A 90% LTV is where the bank is paying 90% and you're putting down a 10% deposit. An 80% LTV is the bank paying 80% and you're putting down that 20% deposit. So wherever you see the letters LTV, that just explains how much you're paying in deposit versus the bank lending you. That's all it means. So that's your LTV. Why is LTV important? Well, after 2020 being such a difficult year, a lot of banks decided that they didn't want to lend to people with only a 10% deposit. They wanted only to lend to people who had 20% or more because that was seen as lower risk, because those people only have to pay back 80%, and if you've got a 10% deposit, you have to pay back 90%. So LTV is important in terms of how many types of the mortgage are on the market. So right now, coming into 2021, there aren't as many 90% LTV, i.e. 10% deposit, mortgages on the market. That should improve over time, but it just means that you don't necessarily have the pick of all of the mortgages in the way that you would do, the more deposit you can put down. So that's the first way that LTV is important. The second way it's important is that LTV effectively determines how much interest you pay, so how much your monthly mortgage repayments are going to be, so the amount that you pay back each month over the term of your mortgage. And overall, the rule is that the higher the LTV, the higher the interest rate. And that kind of makes sense, right? If the bank is lending you 90% of the value of the property, they're taking on more risk of you not being able to pay. And so they want to, and also you have more to pay back. So they just want to charge you a higher interest rate. So if you right now are getting a 90% LTV mortgage, i.e. you're putting down that 10% deposit, you can expect to pay about 3 to 4% in interest. Contrast that with if you had a lower LTV. So if you were putting down, say, a 20% deposit and the bank was paying the 80%, loaning you 80%, then your interest rate might be between 2 and 3%. So you will be paying less in interest, less in your repayments because it's a lower interest rate. And so the more you can put down as a deposit, the more choice of mortgages you're going to have and the lower interest rate you're going to have. But let's face it, most first-time buyers, we're lucky if we can scrape together that 10% deposit. So don't panic if that's you, because you're going to be fine. Okay, so let's talk a little bit about how interest rates work overall, just so you're really, really clear on it. So lending out money is a bank's main business. That's how they make money. So the bank is going to charge you interest on your loan. So say you buy a property that's £200,000. You're going to pay at least 10% of that as your deposit. So you're paying £20,000 up front. And then the bank is lending you £180,000 in a mortgage. But they're not going to just let you pay back that £180,000 over like 25 years. They are going to charge you interest on that amount each year for 25 years because that's how they make their money. And so if you had, say, a 3.5% interest rate, the total amount that you would pay over 25 years, so remember, it's a £200,000 house, you would end up paying in total around £270,000 once you factor in that interest over 25 years. Now that may make you do the whole emoji, but this is just pretty standard. And what you really need to think about is not necessarily how much is it going to cost me in total at this point, but you're thinking about how much can I afford to save my deposit, and also how much are my monthly repayments going to be? Can I actually afford to repay this on a month by month basis? But you should take a look at how much that property is going to cost you over the long term. And that is when you start to look at mortgages and work out if you're allowed to make additional payments on top of your monthly. So we're going to talk about that in a minute, but just hold on to that thought. So we've established so far that you're going to buy something for £200,000. It's going to be a 3.5% interest rate because you're putting down a 10% deposit. And so that's going to cost you roughly £1,000 a month in mortgage repayments. Now that is assuming that you are paying back the interest and an actual chunk of the mortgage. It is possible to get interest-only mortgages, and that's where you're only paying that interest amount. You're not actually paying back the loan. So remember, in our example, the loan amount would be £180,000 and it's 3.5% interest. Now, if you are only taking out an interest-only mortgage, you're not going to be chipping away at that £180,000 month after month. You're just going to be paying the bank the interest that they're charging you on it. And so for some people, they take that out if they're in a position where they can't quite afford all of the repayments. But generally, the best way to do it is to make sure you are repaying the actual value of the property, because then as the years go by, you own more and more and more of the property, and your loan goes down and down and down. The danger if you take out an interest-only mortgage is that you've still got this huge chunk of money that you owe on the property, and you're only ever chipping away at the interest. You never actually chip away at the debt, which is the loan, the full mortgage amount that you owe. So generally, if you can, get a mortgage that is both interest and repayment. That's where you'll be chipping away at the full amount every month. Now, we talked about the total amount that you could expect to pay over that standard 25 years that you're going to be paying back your mortgage. And it's a huge amount of money, right? Potentially spending another £100,000 just because of the interest. But there are ways that you can reduce that. If you find yourself in a position where you can actually pay more towards your mortgage every month than you expected, maybe you got a pay rise, maybe you got an inheritance or something like that, then you want to make sure with the mortgage you take that you are allowed to make what are called early repayments. Because what that does is it says, okay, your normal mortgage payment amount is £1,000 a month, but actually you find that you can pay 1,300 or maybe even like 1,500 a month, or at least a few months. And so you want to look at getting a mortgage that allows you to kind of throw a bit more money at paying it off earlier, because that is going to reduce the total amount that you pay for the mortgage over that whole 25-year period. So when you're talking to a mortgage broker or you're talking to a bank about a mortgage, you need to find out, are you allowed to make early repayments? If you're allowed, how much are you allowed to do? Some banks put a limit on the amount that you can the additional amount you can repay every year. You need to find out if there are any fees that they charge for early repayments and just work out like what is the best option for you.